Good morning and welcome to the IX trading room with me, Richard Perry, market analyst for INFINOX. This is the last one we're going to be doing in 2022. Without further ado, I will get into it. We've got about half an hour. Now, what I'm going to do is I'm going to be sort of playing through the platform, and I'm going to be doing that with a view to sort of giving some market analysis and sort of potentially putting some sort of demonstrating how to put trades on and certain levels and trading strategies and things like that. So we're going to be looking at that, and through doing that, we're going to be sort of demonstrating the platform. This is the MT5 platform we have here that I'm hoping that most of you are aware of. And that's what we're going to be looking at. So yeah, so I'm going to kick off with looking at a bit of Forex, looking at how markets are reacting at the moment. Obviously, we've got a lot of issues going on, a lot of central banks coming out with some moves that have surprised markets to an extent, and markets have reacted to that. So looking at that, and then going to look at commodities and equity markets as well. But starting off with Forex. The main market that everyone always looks at is Eurodollar. Eurodollar has been reacting to both the Federal Reserve and the European Central Bank in the last week. And subsequently, what we've seen is that Eurodollar has sort of consolidated, really. It's interesting because we had the Federal Reserve, which came out on Wednesday evening, which was slightly more hawkish than markets had been anticipating. And there was a reaction on that. And we saw that Eurodollar subsequently fell last. Let me just get this crosshair going. Sorry. What we saw is Eurodollar falling. Well, a little bit of rally, but then subsequently falling. And the reason it fell was because the Federal Reserve was more hawkish than markets had been anticipating. And then we also saw the European Central Bank the day after also being more hawkish, and the general sort of feeling across markets was that that was risk negative. It was dollar supportive and risk negative, and we can see that since the Federal Reserve, what we've had is that Treasury yields have had a floor put under them. This is the 10-year Treasury yield. We've seen that since this December FOMC. Treasury yields had a floor put under it, 3.04%. Treasury yields have rebounded across the 2-year and the 10-year to extent. 2-year not so much, but the 10-year mainly. We've seen that move through the 10-year yields, and that what we've seen is that bond yields generally across major markets have risen since that Fed decision. And sort of the ECB has played its role in that as well, but mainly the Federal Reserve. And it's interesting that we've seen that Eurodollar has just dropped slightly, only slightly, not too much. And it's essentially because the European Central Bank was also fairly hawkish. So it sort of leveled each other off, and dollar has not really strengthened that much against Eurodollar. And what we can see here on Eurodollar is that the market has sort of come back towards this breakout area of support here and held ground. And the technicals are still very positive on Eurodollar. And that, I think, is interesting in itself, in the fact that we've seen that the rally that we've had in Eurodollar pretty much since October, but slightly before, actually, in the case of Eurodollar. The accelerated rally has not really been retraced that much, and that's sort of holding ground into the year end, which looks like it's going to be now, with all the major driving factors out of the way now until the end of the year. It looks like that Eurodollar is going to be holding that. Now, my opinion is that I think that if Eurodollar holds above, got 104.50 up towards 105 big figure, this sort of breakout area here. If Eurodollar holds above that area here, I think that that remains a bullish market into the year end, really. And I think that that sort of then starts to think about whether that can push on and push into the 107s and above. Now, you look at the reaction high that we've got here at 107.85. That was the May high. and also the reaction low back from April, that is a crucial level of resistance. That is the level of resistance I'm looking out for into the early next year. If that can get through that, then it really does accelerate the recovery, I think. For now, I think it's obviously consolidating year-end positioning. You're unlikely to get too much market action, I think, into the new year on euro dollar, but it certainly looks as though it's still positive on the technicals, and whether it can break out above 107.85 is the key question. As I said, holding ground above 104.50 up towards 105 figure is the important support that will then drive a change in the market outlook to a more corrective move. So those are the two key levels that I'm looking at coming into early next year. Looking at sterling dollar, interestingly, because we had also the Bank of England last week, and the Bank of England was massively split in its decision to raise interest rates by 50 basis points. So two of the committee even voted to keep rates flat. One voted at 75, two voted at 50, and sorry, two voted at 0, and they ended up with a balance of 50. So this just reflects how split the Bank of England is, and you've got the UK economy, which is not very well, not especially performing well. In fact, it's performing pretty poorly compared to other economies. And what we've got is that sterling is sort of generally a bit of a drag. You see this as performance in the last month of major forex. See, sterling, it tends to sort of be at the bottom here. This is the green line sterling. It's not really doing a great deal, but it has reacted to the Federal Reserve and the Bank of England. It's sort of consolidating a little bit. Excuse me. It's consolidating a little bit since last week, but generally speaking, it's a bit of an underperformer. And we can see that sorry, get rid of that. We can see that has broken this uptrend, and that break of the uptrend has tested the first reaction low. Now, I talked about 104.50 on euro dollar. The equivalent support on cable is 121 big figure, and that has been, I mean, it initially got breached. 120.85 was the low yesterday, held into the close, but it's broken that uptrend, and it's tempting to break down that below that 21 big figure support. So sterling dollar is by no means as positive as euro dollar. And if you look at, say, for example, the likes of, I'll just get it. This is not the chart I want to look at. Of euro sterling. Euro sterling sort of breaking higher, looking more positive on the RSI. It suggests that the euro is going to be outperforming sterling, only marginally. I mean, essentially, you take this as a range play, but it certainly looks on euro sterling as it's coming up towards the test of the 88.30 area to 88.60 area of resistance, and having broken that downtrend, and with the key break to the upside, it looks as though that this is going to be testing that upside. That would suggest euro outperformance of sterling, and you can basically see that in the two charts. Sterling dollar breaking the uptrend, testing that support. Euro dollar still holding on. So one more zoom in. Still essentially holding on to the run higher and just sort of consolidating, really. So euro dollar is still looking fairly positive, certainly compared to sterling dollar. So sterling is a slight underperformer. Now, the big outperformer of the moment is the yen. Dollar yen moving decisively lower, sharp move to the downside. The Bank of Japan massively surprised yesterday with the widening of its yield curve control band that it has for the 10-year yield around 0, up towards 0.5%, from 0.25% up to 0.5%. And you can see that with the dollar yen falling sharply. Now, obviously we're still continuing this downtrend, but I'm keeping an eye on 33.60 up towards 34.50. This is the old lows, which essentially sort of would be a retreat. That would be an unwind of half of that move of the daily candlestick yesterday. That is the resistance overhead. That is essentially, I think, where we'd see dollar yen rallying into if you saw the RSI on the daily chart unwinding back towards the 40 to 50 area. That, I think, would be selling opportunity territory. Still within the downtrend, and I think that essentially the Bank of Japan move yesterday really does, I think, now open the door to further yen strengthening into 2023. It really does. And I think if you saw the reaction low yesterday, one basically is the massive really important support of 130.40 from that August low, beginning of August. Tested yesterday, 130.57 was the reaction low yesterday. So tested it, but didn't quite make the breakdown. If it breaks down below 130 big figure, wow, I think that really does open the door to 26s. 126 is the area, 126.35 is the next key support of that May low. And bearing in mind how quickly dollar yen moves, and bearing in mind how much dollar yen does trend, it really does. It's a massive trending market when it goes. You can see this through April into May into June, again through the summer. And again, these moves are all really strong trending moves that we see on dollar yen, and we're seeing the retracement of that trend now. Negative configuration, corrective trend outlook. And we can see that rallies are being sold into. You've got this downtrend, you've got the 21-day moving average, which is a strong basis of resistance now. All of these things are sort of adding into, sort of selling into strength on dollar yen. Click into the 4-hour chart. You can see here slight unwind from oversold on that 4-hour, but already it's consolidating. Already it's sort of struggling to really get going this morning. So I think that this all adds up to pressure on that 130 spot 40 big sort of 130 big figure level of support into next year, and a breakdown below that, wow, that really does sort of open the way to the downside. So you can see that these major charts have had some fairly significant moves, not necessarily euro dollar, but on the major forex, cable is sort of testing to the downside as sterling is weakening, and the big strengthening move is still coming through dollar yen to the downside, so yen strengthening there. So in terms of what we're looking out for in the next week, there is basically nothing. I can show you the platform. Show you this calendar that we have now on on our INFINOX website. It's basically nothing really today. Existing home sales today, really that's it. And then going forward into tomorrow, again, nothing really, sort of scrolling through. You've got a few tying up of loose ends for US markets tomorrow, but nothing really. Oh, sorry, today we do have consumer confidence. I apologize. We do have consumer confidence, but nothing. A slight improvement in consumer confidence is expected there. But yeah, tomorrow nothing, and then you basically into Christmas. You've got the final Q3 GDP for the States. Not expected any revisions. So in front of Christmas, you're not really expecting any significant data announcements to affect major markets, really, that I can see. So yeah, we're looking at probably the start of the consolidation now for Christmas, and then first week of the new year is a massively it's dense of tier 1 data. You've got all the ISM and the PMI data. You've got the Eurozone inflation and the non-farm payrolls report. Some really big data announcements in the first week of the year. So be prepared for that. But I think until then, I think we're likely to see markets fairly quiet. Yeah, just one more. I just wanted to show you is the sort of the correction in risk appetite. Risk appetite had been improving throughout October into November, basically on the outlook that the Federal Reserve was going to be pivoting. Well, it didn't, and subsequently, we've seen that in the last week. This was the reaction on the Australian dollar. A sharp correction in Aussie and also the Kiwi. Actually, the Kiwi, that was an interesting move. What we've seen here, let me just get that back. This Kiwi has unwound slightly. Kiwi was previously the best performer on the major forex. It's now sort of turned quite strongly lower, as has the Aussie. So watch out for the Kiwi retracing, interestingly, as risk appetite has retreated. But the Aussie has broken this run of higher lows, and yesterday it sort of did it close 66, 68 was the reaction low, 66, 66. Yeah, essentially has now broken that reaction low, and it's sort of starting to look corrective on that RSI on there. So it's starting to look as though it is rolling over. You've got this uptrend on the Aussie that's still in there. I think if that went below 65.85, then that really would start to be more of a sort of topping area on the Australian dollar. So that's sort of where we're looking at there. But it certainly looks as though the Australian dollar has topped out. It's underneath this moving average, which is 21 days. It's beginning to turn a little bit more corrective, isn't it? Interesting. Look at all these candles, negative candles, selling into strength. All these upside moves in the last 3 days have been sold into. Let's have a look on the 4-hour chart how that looks. Yeah, all these early moves to the upside get sold into the close, and then obviously yesterday to the downside. So negatively configured now on that 4-hour chart. It's a little unwind back towards 50. You've got the resistance overhead on the near-term chart that sort of comes in now around that 66.80 area up towards 67.30. That's a resistance band. It looks as though that is now overhead supply on a near-term basis. So anything up into that area, 66.80 up towards 67.30, sort of selling opportunity. You'd say that given the sort of risk aversion that we're seeing, maybe if I was to pick any trade, I think into the new year in the forex space, to trade over Christmas, and I have to admit, trading anything over Christmas is not an ideal situation, basically, because when markets are flat, you're basically then just sort of hemorrhaging swap costs. So when markets don't do anything, it's not really the ideal situation to be trading in the markets, because you don't really have a proper reaction through markets. When traders are not sort of looking at markets all through the Christmas period, just sitting in a trade just for the sake of it, maybe it's not the ideal scenario. But if I had to trade, if I had gun to the head and I had to trade something, I'd say, well, Aussie to the downside probably is one to look at, bearing in mind the technicals are now looking corrective here on the Aussie, and there's resistances building. 67.30 overhead, 66.80 starts to come in, so we start to look at a more corrective move, but essentially it's unlikely to go sort of too much. So yeah, that's the issue that we have at the moment. But yeah, I'm not sure, but the Australian dollar is looking one of the more corrective sort of moves against the US dollar. This is the into commodities. What we've seen here is the commodity prices have rallied, and gold has picked up. Now I wanted to show you a chart that I'm just a little bit confused about, really, because is it this one? This one, yes. This is real bond yields. Real bond yields are picking up. You've seen treasury yields picking up sharply, 10-year treasury yield. Inflation's picked up slightly, but the sort of general trend has been for yields to be higher, picking up more than inflation in the last sort of few weeks. So real yields moving higher. However, real yields moving higher should be negative for gold. Historically, throughout the last 12 months, there's a strong negative average correlation, is 0.38 negative, where real yields going up should be dragging on gold lower. So gold is not going lower at the moment. So that is a little bit of a strange one for me. So gold moving lower is, yeah, that's something that, so gold should be moving lower if real yields are going higher. So this is coming back to this chart here. Gold has moved higher. So leaves me a little bit suspicious about gold, whether gold can continue to move higher. Technically, you'd say yes, it does. I mentioned, I just did the 3 charts in 1 video, and I talked about gold, and I said, well, is this a slight negative configuration? Sorry, negative divergence, I should say, on the RSI. Lower highs on the RSI, higher highs in the price. This leaves me a little bit cautious about this one being chased higher. Essentially, on a near-term basis, you'd say yes, it's still positive configuration, essentially, but without being outright bullish. It's just rolled over again. You've got the support that comes in initially around $1,800, $1,799. But that sort of fact that real yields are moving higher and gold is moving higher, that doesn't tend to happen for long. So that's a little bit of a question mark for me. You also got a little bit of a question mark here with this slight negative divergence. So it's something that I'm going to be keeping an eye on in going into the new year, is whether that gold can continue higher, whether that negative divergence on the RSI continues, whether real yields also continue to move higher. If real yields do continue to move higher, then I think we have a little bit of a question mark over whether gold can. Similarly, you could extend that to silver as well. Silver moving higher as well. Both gold and silver have negative correlations with real yields. Let me show you, find it. It could be this one. Bear with me. It is this one. Yeah, both have a negative correlation. Silver is sort of 0.34 on an average basis, but it has, obviously, as you can see, the correlation has turned more positive in the last few weeks as real yields have picked up, but as has silver. So again, this is a situation that doesn't happen for often, for too long, tends to be much more negatively correlated. So if real yields continue higher, can silver continue to move higher? Question. At the moment, it's trending higher and broke out yesterday, but has pulled back slightly today. But yeah, there isn't on silver this negative divergence. So the technical outlook on silver is much more positive than gold in my book. So it's still holding that. I'd still be looking at this and thinking on a technical basis, this is a buy into weakness. Any unwinding move is a buying opportunity into support. You've got the support, good support around sort of 23.25 up towards 23.50 area, sort of breakout levels, 23.40, 23.50. Have a bit of an unwind back to 23.50 on this candle here on the breakout. So this is a basis, good basis of support there. So it's starting to unwind. Starting to see that through the 4-hour RSI as well, just unwinding. So anything back towards 50 on that, I think, is probably buying opportunity territory. But as I said, the fundamental side of it and the correlations that we have, that I look at, it leaves me a little bit cautious. But on a technical basis, silver is still positive. Silver is still positive, and oil is still negative. Oil is still negative. Look at that downtrend, 21-day moving average downtrend. Also, the overhead resistance band of the old key lows, 81.30 up towards 83.50. Resistance overhead. So you've got that, and you've got the negative configuration on RSI. So that, I mean, everything about that points towards selling into strength. And you've got the consistent run of sort of bull failures, little 2 or 3 days of rally, selling off, 2 or 3 days of rally, selling off. You can see that throughout this. So consistently, you've got that, and it certainly points towards, I think, retesting of the lows. And going further out, you can say, well, yeah, I mean, it is sort of, you've got the next sort of band of all these old key lows from 2021 come in around the 70 to 60, 65 to 70 mark. So if you breach 75, you're looking at that 65 to 70. But that would be the question: does 75 get breached as support? Certainly looks as though that the continuation of that trend would say yes, or certainly be tested anyway. On to equity markets. Fallen over. Are we going to get a Santa Claus rally? I think you're going to struggle to see a Santa Claus rally. I think the negative configuration on these markets now, the big resistance overhead. I'll go through them one by one. S&P 500 futures, S&P 500 futures resistance 39.12 up to 39.45. Overhead supply. All this old built up through November into December, breached on the Federal Reserve to the downside, and is now overhead resistance for a rally. Similarly, on the DAX, we've seen a little technical rally. That's a bull hammer on the DAX. That's actually quite a positive candle for a rebound. Now, the question mark for the DAX is you've had this top pattern playing out, and essentially, if you measure that, sort of it comes towards sort of 13,700. So essentially, if you take that as the downside target, you have seen the DAX hitting that target, that reaction of 13,691. So essentially, it has hit the target, so of the top pattern, and it's a nice band of support. So this is a question, isn't it? Is this bull hammer going to turn around the market on the DAX? Now we've got Wall Street, which in my opinion is still struggling, and the reaction to that overhead supply on Wall Street will be crucial. 39, essentially 39 big figure up to 39.12, 39.45 is the resistance on S&P futures. If you can break it back above that, then that essentially just turns into a trading range. But for now, it looks like a top pattern, and that means that is resistance of the neckline. The DAX has picked up, and the DAX has already hit the target, and it's back into picking up from support band. So yeah, that's not as negative, you could say. Here's FTSE 100 to finish off with. Again, FTSE 100 hit support of 73.05 and rallied, but again, resistance overhead now up towards 74.40 area. It's mini downtrend playing out. So again, question marks over how these markets play out around these breakdown levels. 74.40 around on FTSE 100, 14.125 on the DAX is the breakdown area, 14.125, and on S&P futures 39.12 up towards 39.45. Big resistance overhead for equity markets that is restricting any sort of technical rallies, or I mean, if you want to call it Santa Claus rally, feel free. But yeah, that is where we're at. Okay, guys. Well, thank you very much for coming today. Thank you. That's sort of me done. On our YouTube channel, click on the bell. You can get subscription to our channel and get notifications and everything there. So please feel free to do that. But I wish you good luck in your trading and a Merry Christmas. And I will speak to you all again early in the new year. Thank you very much.